Hey, what's going on, guys? This is Brandon, your trusted realtor, and I'm coming to you with another great episode. Today, I want to talk to you about that age-old question, where's my money going when I make my mortgage payment? If you think about it, when you make your rent and when you are a renter, you make a payment and you know that that's just covering either your time staying there, or in some cases, if you're lucky, it'll include the cost of one or more of your utilities, right? But when you're a homeowner, that's not the case. All of your utilities are things that you have to cover separately. And in the same vein, it becomes a much larger question of how is my mortgage broken down? Most recently, I had a question from a client, which was, can you make a video on taxes and escrow? And what does that mean and what goes into those things? But I thought, hey, there's a much bigger opportunity here. The opportunity being to break down what that monthly mortgage payment looks like. And the monthly mortgage payment is divided into four categories: your principal, your interest, your taxes, and your insurance. And today I want to spend just a little bit of time talking to you about all four of those, what those mean, and how your mortgage payment is made up. Let's get into it. Now, your principal is the unpaid balance that's left on the loan. Typically, believe it or not, your principal is the largest amount of the overall loan balance, and it is the part of the loan that usually gets paid the least upfront and last. The reason I say that is because the unpaid principal balance is because that is the amount of that your interest is calculated against. So that's the second bucket that we're looking at, which is interest, your interest payment. Your interest payment is the interest rate, and that payment is calculated based off the total remaining balance of the unpaid principal balance spread out over the term of your loan, which is usually 15 or 30 years. The understanding here is that you're putting more upfront towards the interest with each payment that you make per month. So that's why if any of you have already purchased a home, when you first looked at that mortgage statement, you saw that you would pay hundreds of thousands of dollars back for the amount of that property. Or when you looked at that 30-year amortization schedule at the end of your closing documents, you see that each and every month you're paying more money towards that interest than you are towards the principal. Well, that's how essentially the bank is able to recoup money for them extending you this unpaid principal balance, or the remaining amount of the loan that's needed to acquire the asset, which is the property itself. Right. So that's principal and interest. Broken down very clearly, the principal is the unpaid amount of money that is after you have paid your earnest money deposits and the closing costs have been assigned to you, or seller concessions and etc. So after all of the upfront funds have been paid or assigned by you, that's the principal, or the unpaid principal balance. Then the interest is the interest rate that you pay or agree to pay back to your lender against the unpaid principal balance. Now you have your taxes. Your taxes and includes both taxes and insurance, which are the last two categories. Taxes cover what you have to pay for your property tax and what is required by your city and your county. Depending on each county or locality that you're in, you will have to pay some assortment of tax. That tax is going to be dictated by the locality that that home is in and that jurisdiction. So for example, in DC, in the Mid-Atlantic region, some homeowners find that they can actually qualify for a little bit more because the taxes in DC are less than certain properties or certain homes in, for example, Prince George's or Montgomery County. Because the tax rate is slightly lower, homeowners can find that they are able to qualify and spend just a little bit more money and afford a little bit more home. Fun fact, and something important to look at when considering where you want to be and where you want to live. What is the tax rate of the property? And when you get a pre-approval, one thing to keep in mind is that that lender will typically provide you some kind of Excel sheet or some document that indicates what your tax rate is for the locality of either a property or a county or jurisdiction that you want to be in. This is going to be helpful for you to either be able to manually calculate what your tax amount will be, or you can ask what the previous year's tax amount was when you look at properties and you talk to your realtor. That's all general information that's available to you. And the next is insurance. Insurance is going to be the mortgage insurance and covering your property specifically from damages, from issues or loss. Now, it's also going to be important to know a few things, that you can choose your insurance company, and you typically have to pay, depending on the locality or jurisdiction that you're in, you have to pay for 6 months or 12 months of your insurance payment up front. And so one of the things also to remember is that you never want to be in a period where your insurance payment lapse. You always want to be certain that your insurance is being paid and that you have a policy that you have selected. If you don't have a policy that you've selected and your insurance lapse, the reason that your insurance would lapse is if it's a situation where you become delinquent on your mortgage, then what will happen is your mortgage company, if that is the case, will implement force-placed insurance. Force-placed insurance means that they basically, it is the highest of the highest of insurances for riskiest of situations, and sometimes those insurance companies can be $4,000 for that insurance policy, and that becomes astronomical if you are delinquent and you have to then pay not only the delinquent balance that you have, but because the mortgage company had to get an insurance for you, aka force-placed insurance, then that means that you have to pay whatever the cost is for whatever policy they selected. And that can be an unfortunate situation for people if they don't understand the interaction and the interrelationship between their principal, interest, taxes, and insurance. So it's important to know how those things are broken down and where that money goes. Also, as part of the taxes, what I didn't cover is that also includes your escrow balance. Now, a portion of your monies for those taxes goes into an escrow account. The escrow account is then used or set aside by your mortgage company just to pay off your county and city taxes. Those taxes usually occur biannually in most instances. And when they do occur, what your lender does is they take the money out of that account and then they pay the city and they pay the county appropriately. So that way you don't get a property tax lien against your home. The lender will take care of that. Now, there are rare circumstances where you can elect in your monthly mortgage payment to not have the lender do that, but don't do that. That's not a wise move. Have your lender do that, to make sure that is taken care of and paid on time. That becomes their responsibility. Now, one of the things I always advise my clients, and if you watch to the end of the video, then you're definitely worthy of having this nugget because you stayed all the way to the end. When it comes to your escrow account, they will set aside money when you begin to close, when you go to settlement. Your lender will set aside anywhere from 3 to 6 months of money for your escrow account. There's a thing called an escrow shortage. Your lender doesn't really know how much your taxes are going to be because it's not necessarily an exact science. And there's some times where the tax rate change in the middle of a season, and you don't know that, and the lender doesn't necessarily report that to you. And then you'll get what is called an escrow bill. And that escrow bill will reflect a shortage in the amount of money that was needed in order to pay your taxes for your home. As a result, that when they do an escrow analysis of your account, they will say there was a shortage, and so now you have to pay the lender back. That means your monthly mortgage payment will go up that next year. So if you were paying $2,000 and that was a set amount because you were thinking, okay, I'm comfortable with this is how much I can pay. But if the lender didn't get that right, and this happens often, and you see that there's an escrow shortage, it could be a case that next year, when it comes to paying your monthly mortgage payment, your mortgage payment could jump up to $2,300 every month. You won't have, even if you ask for them to do a reanalysis, they typically will not budge on changing that monthly mortgage payment. So my nugget to you is that when it comes to making your mortgage payment, there are going to be two categories. There's going to be a category for additional escrow, and there's going to be a category for additional principal. If you want to short circuit your amortization schedule, add additional money to the principal balance of your loan. That's going to reduce the principal balance. That means there's going to be less of an amount that can be charged interest against, right? That means you'll own the home a lot faster. The second is putting at least additional money towards the escrow balance, because doing that means that in the event that there's a shortage in your escrow account, your monthly mortgage payment the following year will not go up. And worst case scenario is that you'll get a check in the mail for the escrow overage. So think about it as a savings account that you don't even have to manage. So hopefully this has been helpful to you and those out there. If you haven't done so already, remember to like, subscribe, and hit the notification button. And I'm Brandon, your trusted realtor. I look forward to being your resource for all of your real estate needs. Take care and talk to you soon.